Rent to own is one of the most powerful niches that you can learn in real estate. And guess what? Here at Chicago REIA, we wanted to have the one person that is an expert here in the Chicagoland area. And not only is he an expert, but he has built his portfolio, over 200 properties, and he has done exceptionally well doing rent to own. So today we have the one and only Mr. Bill Powers in the studio, and he's going to start from exactly where did he start? Why did he start getting into rent to owns? This is going to be an amazing interview. I couldn't have been more excited to have somebody who's had such massive success. Hey guys, this is Andrew Holmes from Chicago REIA, and we are here with Mr. Bill Powers. And today we're talking about rent to own. And this is a topic that we don't talk about much at all, but today he's going to delve into how he runs his business. And in fact, his business is called RTO Property, correct?
Correct.
So Bill, welcome to the studio.
Thank you.
So let's jump right into it because a lot of people today want to know all the great things about rent to own, right? There's some spectacular advantages when you do rent to own, and can be very profitable. Yep. Before we get into it, let's kind of start with, where did you start? How did you end up in real estate?
Sure. So back in 2010, found myself with an opportunity that I had some extra cash to invest after I got bought out from a manufacturing business in Lake County. And my wife suggested real estate. So we looked at buying one property. We bought one in Mundelein. We made all the mistakes that you could possibly make for your first rental on that property, with long rehab and spending too much and bad tenant and all those things, and got through it, and decided, no, this is still a good business if you do it right. Okay. And so we started to identify properties in Waukegan.
So you had, for a lot of audience that don't know, you have a background that you've been an entrepreneur through and through.
Correct.
Right?
Yep.
You started with a small business,
yep.
Grew it, then got to your next one,
yep.
and then that's kind of how you came to real estate,
yep.
right? So you've been an entrepreneur at heart from the very, very beginning, right?
Almost all my life. A couple corporate jobs in there, but it really didn't fit my personality and my I guess energy, right?
Okay, got it.
So got into real estate, and it's been the best business that we've ever owned.
Got it. And even though you were an entrepreneur, mm-hmm. you did not have all the answers for real estate when you got in.
No, I didn't have 10% of the answers.
10%, okay, good.
But you build the knowledge from making the mistakes, and if I had the opportunity to be involved in the REIA that we have up in Lake County, or your group, right, where they can answer questions and kind of guide you so you don't have the mistakes all the way along, it can be really beneficial.
Right.
So.
And I mean, let's talk about a little bit of the Lake County REIA, because you guys have Miss Linda, mm-hmm. right, that passed away about a year ago. It's been a year now. Mm-hmm. And you and a lot of people have put a lot of love. It's a labor of love, right? It's a pure labor of love that you guys have put in. And because if you had that to kind of learn from, your business would have taken off at a time in 2012 at a very hard pace. Yeah. Correct?
Yeah.
So let's jump into it. 2010, you get into real estate. Yeah. You try your hands on a couple of rentals, mm-hmm. right? And you didn't go quite as well as you had planned. Why did you stick it through?
You looked at the numbers of buying real estate at the prices that it was at, and it just, the cash flow made sense. Okay. And to this day, that's the way you have to analyze a deal, is just based on cash flow. And that's what we do consistently. And that formula was easy to follow. Invest $10,000 and try to generate $200 a month in cash flow from that property. That was kind of our formula. It's the bigger pockets 2% rule, but in a different way of calculating it. That was easy to follow through 2016 for ourselves, and I brought in a lot of friends and family that invested in a lot of property too, and it just was, it was a great formula, and it worked really well for a long, long time.
So let me just repeat that again. The formula that you followed was fairly simple, and it was based on a cash flow formula.
Correct.
Right? You weren't basing it on appreciation necessarily.
No.
Obviously, it's a good icing on the cake, but you followed the formula where it's $10,000 invested, and every month it makes you $200.
Correct.
Or for yearly, you're making about $2,400. Right?
Yes.
That's kind of it's easier to remember. 10,000 invested on a yearly basis, you make $2,400 on your investment. And think about that. right? 10,000 invested and $2,400 return. What is that in terms of try to match that at Goldman Sachs, right? It'll be an interesting conversation when you have that. I mean, those returns are impossible in almost any other business, right?
Yeah. I mean, and the special advantage that real estate has is the leverage, right? You take your money off the table and you go reinvest it in something else. Not at crazy levels, but at levels that are comfortable and conservative and give you the opportunity to reinvest that capital because it's cash flowing.
Right. And I mean, from what I know of you, you're not a very adventurous guy in terms of you're not one of those people who'll just swing for the fences and plan on losing money, right? You tend to be very conservative and you're thought through in your investment choices.
Correct.
Right?
Yeah.
So you start with rentals, and then did you get into flips? Did you get into wholesales? What was kind of the next transition year-wise?
So for 4 years, we just did rentals.
Okay.
And then in 14, we got into a few flips, did a few, 2, 3 a year for a while, and then started to do 10 or 12.
Okay.
And those worked well. You know, it was it was the day job, right? And the retirement was the rentals. And we were still building that portfolio all the way along. Had multiple crews doing all the rehabs, and that was, you know, the pieces to our business that really drove it were setting up your financing so that you could take those batches of properties when they're done, and you could take them to a local bank and get the financing on them that it's going to enable you to do more, and our rehab crews. You got to set up those contacts that really build that business quickly.
So this is a question, and I mean, we're talking about it. You came in the studio, and a lot of times, right, today, with some of the crazy videos we do, right, with the studio, a lot of times people will see today, they don't see last 10, 15, 20 years worth of work, and they're like, oh my God, can I get rich in real estate, right? So that's a question for you. Can somebody watching this video get rich in real estate? Because most people we live in a microwave society, right, where they want to basically push a button, boom, give me the formula, and I got rich.
Right. You know, I was doing an event last night. It's called Flip or Flop Lake County, and we had about 30 people there. And 2 new investors came up to me after the presentation, and they're like, "God, this was great. How do we do this?" You know, and honestly, it takes time, right? It takes money, you know, to set up your teams and to do everything. So, can you get rich? You can, but it's not overnight, right? I mean, the microwave doesn't work in this, especially in this market today.
And you know, there's a famous quote that Anthony Robbins once made. He said, you know, we overestimate what we can do in a week, in a month, or in a year, but we underestimate what you can achieve in 5 years. And in real estate, literally in 4 or 5 years, you can build $1 million to $3 million portfolio. And you can have a ton of equity, ton of cash flow. But the results, it takes a little bit of time. And once that snowball gets big enough, I mean, it is bigger than you're like, oh my God, right? But that takes a little bit of time. And most people, I think, they never have the patience to get through that. Would that be a correct statement?
I think it is. I mean, and some people get to blocks in the road too, where they get to a certain size and they can't find their way past, you know, now how do I manage those rentals? Now how do I service those rentals and maintain them, and you know, and continue to grow the business, or find more financing when a small bank that's in your area has said no, that's as much as we're going to take from you. You know, so all those things have to be overcome while you're building that business.
And you know, one thing before I move on, I also see is I truly feel that people don't give their business enough of a time to grow before they start picking the fruit. Meaning they don't reinvest. They do 1 or 2 or 3 things correctly, and suddenly now they'll go and buy an expensive car. They start, they really believe they're a multimillionaire even before it ever has showed up, right? Just because it shows up on your books, right, on paper, doesn't mean it shows up in your bank account. There's a time period, right? Do you see that? Is it different? I know that's the case here in Lake County up north. Is it any different?
No, it's the same. You know, you might have $1 million, you might have $5 million on your balance sheet, or 10, but you have to keep taking that cash flow and reinvesting that cash flow in order to grow your business. And it's even more critical in the early stages, right? I mean, you have 10 rentals and you have $15,000 a month coming in cash flow. That's not all free money that you can just go out and spend. It needs to be reinvested in your business so you can grow that to a level that you know, it's really going to be a retirement for you.
So 2010 you start till 2014.
Yep.
You said you were kind of going along that rental route,
Yep.
right? And in 2014 you start into flips. Is
Yep.
that correct?
Correct.
Okay. Was there something that prompted you into getting flips? What was the thought process?
You know, there's a gentleman I knew that was doing flips, and I was doing rentals, and so we kind of exchanged knowledge.
Okay.
And he got into some rentals, I got into some of the flips. You know, looking back on it now, at that time, it would have probably been better for me to stay just purely in rentals, because now, the flips you still can find, right? The rentals that we bought at $30 or $40 or $50,000, they're gone, right? And now those houses are worth $150,000 or $200,000, and we never banked on appreciation. I still don't bank on it. I bank on what's the value of the assets from a cash flow standpoint.
Correct.
And that value is $150,000 or $200,000 per home, if depending on how you value it, and all the other factors.
It's interesting because I'll never forget 2008, 9, 10. I mean, all the way to 15, almost 16 even.
Yeah.
Right. You pull up to a property. The car you're driving is losing value every day. Yet it's more expensive than the investment properties that you're buying.
Right.
I mean, it was kind of it was just so kind of crazy. And the markets are turning. 2012, 2013, you could see this turn, but there was still uncertainty, right? And there were a lot of values, Lake County and some of those areas. I mean, America was for sale, right? So you start doing flips in 2014.
Yep.
And are you still continuing to do flips 7 years later?
We are. We're, we used to do, say, a dozen a year. Now we're down to half a dozen, just because the deal flow, we're very picky about what we do now. And, you have to be cautious in a market that, last year in the Chicago market, it wasn't robust, right? Flips sat on the market longer. than what we wanted to, what everybody wanted to, right? But, and you're optimistic for 2020, but you just don't know. So you have to really pencil your numbers and make sure that they're going to work out right for you.
So you guys are in a unique market, right? Lake County is kind of interesting.
Yeah.
You have properties that are extremely cheap, right? Some have crime issues, some have other economic issues, and then you have properties that are some of the most expensive zip codes, right, in the Chicagoland area, right? How do you deal with that? Where did you start? Did you start with the cheaper end of the properties? And why?
Yeah, we started at the lower end. It was a capital issue for us, but it was more a rental focus, right? And where you're going to get the cash flow is out of those zip codes that are really workforce housing, and that's how I categorize it today. I mean, workforce housing is the market to be in, whether you're in Chicago or I won't say LA because you can't buy anything there, but wherever in the country, Charlotte or Orlando or Dallas. I mean, workforce housing really does deliver the best returns. It's more management intensive, right? You have to be able to handle the client base and handle the issues that come along with aging housing stock that might need more maintenance, and be able to deal with that. So
I love that term, workforce housing. I'm stealing that term.
Sure.
Anytime, whenever we always have smart people on, when they say some smart things, I write them down and I steal them, right? But I mean, what a great term, because if you think about it, we categorize housing as A, meaning affluent, D, meaning disasters, B, meaning bread and butter, and C, meaning some challenges, right? And B, bread and butter, and some challenges is kind of where we like that market, which is exactly what you called workforce housing, which is perfect. So that's kind of where you started. As you're doing flips, everybody is fascinated by some of the big flips. I mean, you guys have the Winnetkas, the Glencos, the Glenviews. I mean, all these areas that are just super, super high, Lake Forests of the world. You guys do those big monsters, or what do you stick to when you do flips?
So what we stick to now is sub $400,000.
Okay, right? Under 400,000.
Yes.
Explain why.
Because the market, the base of the customers for that type of product in the Chicagoland area is bigger. And to define it even further, we prefer sub 300. We have a Grays Lake and a couple of Fox Lakes, and in different projects in those type of areas that we think will garner the attention of a more broad customer base. Versus we've done flips in Lake Forest. And they've been $600,000, $700,000, $800,000, starting at $1 million on the list price. And just they haven't turned out the way you expect,
You know,
because the market time is astronomically long, and the buyer is super picky, and it's just very challenging.
It's because it's always interesting, right? On TV, they always show these $500,000-$600,000 flips, right? And the buyer is, he's a sous chef somewhere. She's a teacher, and they're buying this astronomical house, and you're like, it doesn't work in our market, at least, right? But because that's not reality. That's really not reality. And the fallacy is, the bigger the property, the higher the profit. This is a pure fallacy that people have. The bigger the property, the higher the risk I take, the more the money I'm going to make. What have you found?
Yeah, you have to look at it from a percentage standpoint, right? That's bottom line. You have to look and say, I'm going to make 20% on my money that I've invested, or more, right? And really, you have to target on the or more, because when you open a wall, when you start a project, I don't care who you are, it's hard to see everything that's going to come at you, especially with housing today, which is, you're seeing more and more distressed product. You don't see the CPAs anymore, right? You don't see a carpet paint appliance type of flip anymore. It's very, very rare, if you ever see it at all. You have to have crews that know how to rebuild a house, essentially, and that's where you're going to be able to make the money, I think. So.
That makes sense. So we tend to kind of be on the same page, right? And anybody who tells me that I do big flips, Andrew, I'm like, let's talk next year, right? And they're never around to have that conversation the next year, because they always seem to disappear, meaning they go out of business. It's just the sad reality. So let's jump into the whole kind of how this whole rent to own came about, because that's really why I wanted you to be here, because I think you've done it well, and you're articulate enough to be able to really kind of get the good and the bad. So what exactly, for people who don't know, what is rent to own?
So for us, rent to own means we provide our residents, and we don't call them tenants, they're residents, we provide them an opportunity to buy the home every time they step through the door. We look for folks that actually do want to buy. We don't want pure renters in our single family homes, because our goal is to build ownership in the communities that we're in. So Waukegan is the first one we really delved into heavily. It's where my wife is from, where her family's from. We built an affinity with it because we know some of the aldermen, some of the people who are longtime residents, and we just said, hey, we want to try to build more ownership here. So we bought distressed property. We fixed it up at a very high level, granite, stainless, hardwood, new windows, new HVAC, all the things that are going to make a home really durable for the long term. And we provide it on a 3-year lease. And that lease also has an option for the resident to buy the house at the end or during that 3-year period. We provide them a credit every month of $150 towards the purchase price. We stay away from, and a lot of rent to own gets a bad reputation for taking big down payments up front, right? There's legislation that has come through in Illinois that has actually stopped that, which is a good thing, because sometimes people put big down payments down and then they can't get the loan that they need to get, and they've lost that money. And we treat it more as just a regular lease that they have the opportunity to save with this $150 a month. Plus, we provide them access to local nonprofits that can give them down payment assistance, that can give them education on how to get ready to be a homeowner. And really, it is an ongoing process, right?
So, I mean, the reason I've a lot of times had a bad taste in my mouth because a lot of times the way I hear it, it's interesting talking to you, because truly you're trying to improve the community. You're trying to provide your residents, I love that, like instead of tenants, the residents, because that's really how you want that mindset of people who move into your property. You're almost, by my standards, you're over improving the property to a flip standard, right? Where you're providing really nice things, and hopefully they see that. You attract the good quality people who aspire to be homeowners a year, 2 years, 3 years down the road, right? So you're cultivating that within the people that are attracted to your properties.
And the other thing that we do, we require that the applicants have at least 3 times income compared to rent, because you don't want to get people into a situation where they can't afford the home that they're in. And so we're very, very strict on that point, because it's the only path that we see to home ownership, to be able to handle that.
Got it. So you're setting them up for success, at least from your end.
We're trying.
Right? Well,
Yep,
from
we're
your
trying.
end. Okay, good.
Yep.
So now let's kind of look at it from the investor side, right? Why rent to own? What are the advantages for us as investors?
Sure. So rent to own for an investor, I think, you get a higher quality resident in your property. You get a long-term lease in for your property. You do run into the situation where sometimes you leave money on the table. Okay. And what I mean by that is we set our purchase prices when somebody moves into a home. So who could have predicted 40% appreciation in 3 years in Waukegan? Nobody. You couldn't. So when we set our prices 3 years ago, right, some of the homes appreciated way beyond the price that they could execute at. Right. So they got a great deal when they bought. Right. And that's fine. I mean, there's pluses and minuses to the process. I'm happy when folks can. We have somebody coming up right now. They've been with us for 6 years, so that means over 6 years he's saved over $10,000 in credit. The home is only $129,000. It's worth $160, one more. Amazing. I don't know, $170. Right. And so he'll buy it for $110. We're leaving money on the table, but it's provided him and many other people who were really high quality tenants for a long period of time. That some of them do execute, some of them don't. Yep. And it's just the ongoing education we think is the biggest key for us in 2020. We're going to be working with our local nonprofit, housing nonprofit called SEPA, Community Partners for Affordable Housing, to do more education with our residents so that we can get more execution on our rental homes.
I love it. I love the thought process behind it, and that from your end, you're putting them in a position where they can win.
Yes.
Right. A lot of times, the reason I had kind of a bad taste was because people are being set up in certain cases to fail. Yeah. And the conversation starts with, Andrew, 99% are not going to buy the property anyways, man. So it's a great way of taking a bunch of down payment. And I didn't believe in it for that reason.
Take the down payment.
I'm like, listen, I don't want that part of it on my head. No. I just want nice long-term leases, and that's it. Yeah. So in these types of things, when you're building, right, you had some savings, some maybe profit that you took from your business that you dumped into real estate, but you've done a really good job of strategically partnering with people, and you've been kind of the go-to person who's the quote-unquote entrepreneur in this, had the ideas, was willing to put in the work, take on the stress. How did that exactly, was it friends and family? Was it people that you met? How exactly has that worked?
Yeah, the 3 of the 4 people that we work with, friends and family, right? Okay. One of them became a very, very close friend. So, it was great to share in the success of building fortunes with people that you really care about. Right. And, so I was fortunate to be able to do that. And so they entrusted me with, a lot of their money to go out and buy these homes, fix them up, and then build this cash flow machine. And, it's been great for them. It's been good for us to build a little bit bigger organization.
Then you could have by yourself.
Yeah, than I could have by myself. And so, it's been a win-win. I mean, it's really a good opportunity. And I would suggest that to other people who are looking to build their own organizations. If you can make a little bit of a GC fee and get a fee for, maintenance and accounting, and that's all the services we provide, then those are great things to build your business.
Got it. Any advice for people today that they're looking to invest as we look kind of into 2020, right? Where do you think we are with the market? Does the rental market still exist, number one? And then what about flips?
Yeah, in single-family homes, I think there are rare opportunities out there. You have to have a good network to really find those opportunities in the single-family home area. The challenge that you have with buying a single-family home, and let's say you get a great deal on one, and you look at it as a rental, it's hard to say, it's hard to not flip that house because the spread on it might be huge. Yeah. We had one just recently where we bought in Waukegan for $25,000. It was a disaster, and we fixed it up for about $70,000, and we sold it for $180,000. It made more sense to sell that house and redeploy that capital in other places, like a multi-unit that we just bought, than it does to keep it as a rental, because as the taxes go up and everything else, the cash flow gets squeezed a little bit. and you have to find a place to deploy the capital in the best place that's going to make the most money.
That's fascinating because we have done that from time to time, right? We've taken some properties where you have a $50,000, $60,000, $70,000 profit, right? And taken that profit and then redeployed it to buy 6 or 10 more rentals with that same capital.
Right.
So you're actually, because I'm 100%, I tend to be very rental focused, right? But yet there are times where you can strategically do a flip, reparlay that money to be able to buy, in fact, a lot more than you could have just keeping that one property. And that's really strategic business building. So in terms of flips, what do you see in the market? You mentioned the price range is important. Some of the areas that you pick, how about the area selection?
Sure. Well, I mean, we used to exclusively be Lake and McHenry County. Now we've expanded that a little bit. We're going down into Cook with one of our first projects. But that's primarily where we're focusing. We are venturing across the border in some of our searches now to Kenosha. Looking to potentially buy something up in Milwaukee before the DNC. We have a part of our business that's focused on Airbnbs in Libertyville, and so we're looking to expand that up in the Milwaukee area. Because I think there's some opportunities there.
So that's interesting because that brings me to the topic of, man, we're next to Indiana and we're next to Wisconsin. Illinois, Chicago is terrible. Rental laws, the taxes are high, everybody's leaving Chicago, right? So let's address that, right? Because yes, there are challenges, right? There are challenges with Chicago, but clearly the highways aren't getting any less crowded. Right, let's keep it in perspective. I don't know about rest of Illinois, but Chicago for the next 50 years is not going anywhere. Right. What about investing in Indiana or in Wisconsin, right across the border, because that has its own challenges. Right.
Yeah. I mean, we've stayed in Illinois for the past 8 years because it's kind of been the perfect storm for us. From the acquisition was low at the time, the real estate taxes were low. And the rental rates compared to those two other markets are astronomically higher. They're still today even 20 or 30% or more higher because we're in a dense area that it creates opportunity. In our little pocket of Waukegan, the Hispanic community is very, very strong. They love the town. They're hardworking. They pay their monthly payments, and they're great tenants. So you just find those pockets where you have the best opportunity. Kenosha's finally getting there. Their rents 3, 4, 5 years ago were easily $400, $500 a month less than the same house in Waukegan. Yet, my taxes were maybe $100 or $200 a month higher. That's okay, because I'm getting $400 or $500 more in revenue on a monthly basis. So you really have to look at all aspects of the investment.
And you're absolutely right. Like the trifecta, right, which is the housing price versus the interest rate versus the rent. Right. That factor, if you look at in Wisconsin versus if you look at in Indiana, and you take Chicago in general, right? In Chicago, you still have. We still are on every single property, $400 net cash flow after principal, interest, taxes, insurance, management, right? And those numbers, almost anywhere else in the country is impossible to do, right? And we're in a unique market, but it is a steep climb, right? It's so as we kind of, for somebody who's new, looking at, you've kind of been on the leadership team up in Lake County, right? You guys have been trying to encourage investors to invest. What do you tell somebody that kind of looks at you saying, oh my God, it's worked for Bill, this is awesome. I want to kind of follow in the footsteps. I want to be a real estate entrepreneur. What do you say to them in 2020?
I say to a lot of folks who are looking to do this, first of all, don't quit your day job right away, right? It's the biggest mistake people can make is, you think you want to become a real estate entrepreneur, you buy a deal, a 2, 5, and then you go, okay, I'm going to do it full time. Until you replace that daily grind income, don't let this be your side hustle, right? And build up that fortune. To this day, I still don't touch my income from my rentals, right? And it's a portfolio of over 100. Don't touch it, right? It continues to grow. You know, there's 25-year AMs, there's 20-year AMs. I used to do 15-year AMs. Let it pay down the debt. Or when you refi that, allow yourself to reinvest that money in even more property. And so that's what I tell folks is just, you know, build that portfolio so that you can reinvest it. And there's still deals out there to be able to do. You might not get 2%, right, on your cash flow on a monthly basis, but if you can get 1 or 1.25 or 1.5, depending on the type of market that you're investing in, you're going to build that fortune a little bit slower, but you'll build it.
I'm so glad you said that don't quit your day job. I mean, this is something that constantly we have, as you know, so many people today in Mastery, right? And a lot of the people nowadays that come, they're professionals, right? They're making a couple $100,000 a year, and they're like, Andrew, I want to quit. I'm like, listen. Now, how long did it take you to get here? You're 40, 44, 45, 50 years old, right? You're not going to get in real estate, I don't care what you do, and tomorrow replace your income, right? And even if you could, it would be absolutely disastrous for you and your family for you to quit your job. You keep your job for the next 5, 6, 7 years, pay down your debt, and when you're way more than what you really need, that's when you ease off. Maybe become a contractor and start, you know, basically doing consulting or something, and easily take the pedal off. You don't just quit what you've worked all your life for, right? And in terms of investment advice, as far as should people look at rentals, should they look at, you mentioned Airbnbs, you're doing obviously a lot of rent to owns, or flips. Where should they go?
Really depends on their goals, right? You know, a flip is a day job, right? It's going to be a lot of work. It's going to be, you know, hours on end to really manage that project and finish it effectively. Whereas, you know, if you're looking for retirement income, the rentals are a good way to go. On the Airbnb front, you know, we've developed that because we have a built-in customer base with the Navy training station up in Lake County. And we get a lot of clients from that. But we also get a lot of long-term corporate, a lot of, you know, coming in to see the family for the week or the weekend or whatever it is. And you know, the Airbnb business has been good for us in downtown Libertyville. I would encourage people never to underwrite a deal based on the premium that you can make from Airbnb revenue. You have to do it based on the local rental rates that are going to, annual rental rates that you're going to get out of that property. So, you know, but where I would start with the deal that, you know, you have to be somewhat flexible, but the deal that presents itself to you, and base it on what your goals are. And I encourage everybody to do this as a retirement piece. So rentals would be really where I'd push everybody, whether it's find something and make it an Airbnb or long-term rental. Got it.
So as we wrap this up, you guys still buying auctions?
We do, you know, occasionally. Not a lot of deals come through on auction. We buy from wholesalers. We buy a little bit on the MLS. We'll buy directly from banks every once in a while. We bought an 8-unit apartment complex in Lake Bluff with a partner who had been in discussions with somebody to buy it for 10 years. You know, so it just takes time to find the deals. So,
Got it. Okay, great. So I think this would be really, really informational, especially because that was a topic that we don't cover, right? And I love your take on the rent-to-owns because it's truly something where it can be incredibly profitable for you as the investor, quote unquote, and for your residents if they end up executing on the property. So having said that, hopefully you guys enjoyed the interview with Bill at RTO Property. So Bill, thank you so much, man.
Andrew, thank you.
I think people will enjoy it.